actually a lot of these stablecoin rates, once you start getting into that kind of territory where you're literally doubling your money every year from lending stablecoins, that's pretty good. You learn a lot about risk management. That's something that they take very seriously. And in particular, looking at if you're managing a portfolio, thinking about, okay, what are the different scenarios in which I lose money and what are the different scenarios in which I make money, and making sure that your downside in the worst case scenario, you're still going to be in the game. There's always going to be deals that are good deals at any stage of the market. I think valuations have gone up for a lot of projects that have tokens that are like close on the horizon is generally what I've seen. You can totally make a ton of money this cycle by investing in liquid tokens because you're able to sell. But if you're investing in something that has a multi-year lockup, there's no guarantee that you're getting those tokens this cycle. And it's also, if you just dump everything that you have, it's also bad for the project. People are always going to have FOMO and invest in the top. And I think you just have to fight your instincts along the way and say, like, if I'm investing without, like, just because other people are interested, that's generally a red flag.
Hello à tous l'équipe, j'espère que vous allez bien. Aujourd'hui, on se retrouve pour une nouvelle interview. Cette fois-ci, j'ai le plaisir de recevoir Colton Conley, qui est tout simplement le fondateur de Prime Protocol, mais aussi un VC, donc il travaille chez Arrington Capital. Par le passé, il a aussi fait partie de Citadel en tant que trader. Donc, j'ai pensé que c'était un profil assez intéressant puisqu'il couvrait la partie tech en étant lui-même founder d'un protocole DeFi. Il abordait aussi la partie argent, money, avec la partie VC. Et je pense aussi que toute l'approche modulaire aujourd'hui crée un problème de liquidité et un problème aussi d'interopérabilité. Donc, Prime Protocol a vocation à essayer de couvrir et résoudre au mieux ce problème-là. Et donc, je pense que ça peut être une discussion assez intéressante à aborder. Hello, Colton, can you hear me?
Yes, I can hear you.
How is it going?
It's going great. Going great. Thanks for having me on. How are you doing?
I mean, I'm doing pretty good. I think the market have been pretty good with us for the last few weeks now. So I'll cross my fingers and hope it continues like that. I'll do my best also on the English side. So if you have any issues to understand me, don't hesitate to cut me and to mention it. So today, I think we can mention like a lot of things, a lot of topics around like what you've been doing at Citadel, at Prime Protocol, and also your role today at Arrington Capital. So maybe to start this interview and this podcast, like maybe could you introduce you and tell us a bit more about your crypto journey and also your TradFi journey in a way?
Yeah, for sure. So I'm Colton. I'm the founder of Prime Protocol. I'm also a venture principal at Arrington Capital. I've been doing crypto since like late 2016. Originally, I just got into crypto as a retail investor. I was just buying ETH. And back then, it was mostly just centralized exchanges that were around. And I'd been coding since I was a kid. I grew up in Silicon Valley. And I noticed that at the time, there was always a different price on each one of these centralized exchanges for Bitcoin, ETH, and other cryptocurrencies. So I started building arbitrage bots to go between these centralized exchanges. And I made some money doing that. And I also built some mining rigs. I mined things like Monero, Zcash, Ethereum, all of those OG tokens from back in the day. And I ended up still staying in crypto. I was still trading and investing in my personal life. When I got to college, I did econ research with a professor who I met through one of my first macro classes at Yale. And that turned into a couple papers that got published on crypto from more of a traditional finance lens, doing like quant finance, asset pricing things, and evaluating basically whether crypto was a good thing to hold in your portfolio. And the answer from the research was a resounding yes, you should definitely have crypto in your portfolio. I ended up getting sucked into traditional finance just because there's a lot of opportunity being right next to New York City. And my first job over the summer in like a traditional finance role was doing trading at JP Morgan. And then the next summer, I did trading and quant research at Citadel. And what I focused on there was, because I was a math and stats and econ guy, was fixed income. And so at Citadel, I was on the interest rate volatility desk. And that's basically betting on options that have to do with interest rates, is like the bread and butter of that business. And it was pretty interesting. I ended up going back full time after college, and I worked with the quant team. I worked with the trading team, built some models to help model our risk a bit more effectively. Also did some execution trading, managed our FX risk. But ultimately, crypto was still my one true love. And crypto was also the only thing that you could trade without approval when you're at a large hedge funds like that, at least at the time.
Interesting.
And so I was still able to continue. I'm a total DeFi degen. So I was still able to do all of my DeFi stuff. I was aping into everything back in 2020, 2021 that probably a lot of your viewers were, and doing quite well at it. And I did have a big frustration though. And that frustration was it was very difficult as more and more of these L1s and L2s came out to manage my liquidity and positions across different chains. And in particular, I would see these opportunities for things like farming or LPing. And maybe I only wanted to be in the position for like a week or two. And I didn't want to have to pay an entire point or half a point in order to bridge back and forth to those ecosystems. What I really wanted was some kind of lending protocol that gave me on-demand liquidity wherever I needed it. And that was the genesis for the idea behind Prime. It was really just something that I wanted to use for myself. And I thought that if I was going to find this useful, there were a lot of other people who were going to find it useful as well. And so I left. I started Prime. Arrington Capital was one of the lead investors. And we also had a ton of other great investors and great support for starting the project, like Framework, Jump, and a bunch of others. And we got to building. Originally, the idea for Prime was to be a cross-chain CDP. And we actually, all of that built out. We've tested it all on testnet, and we could deploy that at any point. But after Terra Luna crashed and then Celsius, and we went into the bear market, a lot of the CDP competition basically went to zero. Unless you were Maker, it was really hard to bootstrap a new stablecoin because you were going to end up relying on token incentives for some kind of stability pool. And as the value of governance tokens went down, so did the value of these protocols and the amount of liquidity they could have in these stability pools. So we moved to doing a money market strategy and built that synergistically with the existing infrastructure we had already done. And that's what's live on Prime Protocol today. And by money markets, I mean something similar to Aave, like a liquidity protocol where you deposit a variety of tokens. Those tokens can be lent out and they can also act as collateral. And the unique thing about Prime is that it's not single chain isolated systems. It's all one connected system. So like if I deposit tokens on Avalanche and I want to use that as collateral for a borrow on Arbitrum, I could do that. I don't have to worry about bridging. I don't have to worry about wrapping those tokens. I don't have to worry about paying bridge fees. There's no upfront cost to doing so, just the variable interest rate like Aave. And now we're on at least it's 9 chains now. We have a few more that are in the works coming out soon. And we have tons of assets supported and even more that are coming out this week and very soon as well. So there's a lot of great stuff going on. The protocol, we originally launched the mainnet. It's now been a year that we've been live and we've grown a lot. Started out as something small. We didn't have any token incentives, nothing to bootstrap liquidity, just wanted to throw it out there and see what the natural demand was. And it started out from sub 1 million to now in the ballpark of 10 million. It's been as high as 15. It's been actually really interesting to watch demand in the lending markets change from the bear market now more towards a bull market, because in the bear market, everybody just wants to deposit USDC, and that's what they want to use to farm things. They don't really want the Bitcoin exposure. They don't want the ETH exposure. And now the rates are just through the roof on all of these USDC pools. You can make so much money lending stable coins.
Yeah, I've seen 30% for 30% APR on USDC lately on Aave. So I guess pretty much the same like on Prime or other protocols.
There are some chains where on Prime it's higher, like over 50 in some cases.
But the thing is that is it really interesting to give your stable coins and get 30% a year when you can, I don't know, buy Bitcoin or buy Ethereum and probably make better return on investments? I don't know. I think that's why we don't see a lot of people maybe lending their stable coins so far. Do we have a supply shock, I would say, problem now with a lot of people demanding stable coins and very low amount of people lending their own stable coins?
I definitely think that there is a lot of demand for leverage in the system. And there's not very good centralized counterparties to service that demand because they all blew up. And the safest way to do it is through DeFi because it's all over collateralized. I think, well, I agree with you. My portfolio, I have stable coins that I'm lending, and I also have crypto that I'm holding. And I think it's good to have a diversified portfolio. If I'm making 50%,
you're not so degen anymore now.
Well, I guess as your portfolio grows, you want to like take some profits off the table sort of as it runs and park it into really high yielding opportunities. And then the other thing is like you can use that as collateral to leverage up, and different stable coins have different rates. And on Prime, there's also different rates across the different chains depending on where the demand is. So like something you could do today is you could literally like there's massive arbitrage if you want to lend on a high yield chain like Moonbeam right now and borrow on a lower yield chain where there's a bit more liquidity like Polygon. And then you can loop that position. So there's a lot of really lucrative high yielding things you can do. And the other thing you could do is the headline rate on like USDC isn't necessarily all you could earn. Like one thing that I'm doing, if you're familiar with all of these Pendle strategies, where you can take your restaked ETH, you can get, now it's like 70% return on some of these PT tokens. You could borrow that ETH from Prime at sub 3% today. And then you can make that entire like 70% spread. In addition to right now, some of the USDC pools are yielding like 70%. So then you're earning like over 100% APY in your stable coins. That's not a bad deal.
Not bad.
Like I actually think there is an argument to say like, do you actually think that Bitcoin is going to be at 140,000 or higher in a year? And there's an argument that is basically, no, it's not. Maybe it's like 100, 120. We don't actually know. And so you have to also factor in like the wide variability you have there. It's also totally possible that Bitcoin's at 250. And I think, a lot of this depends on how the macro environment evolves, whether BlackRock keeps buying, and whether people choose to hold on or start taking profits. So yeah, I think like actually a lot of these stablecoin rates, once you start getting into that kind of territory where you're literally doubling your money every year from lending stablecoins, that's pretty good.
Cette vidéo vous est présentée en partenariat avec DYDX. DYDX est la solution décentralisée qui vous permet de trader les principales crypto-monnaies de manière liquide sur mobile et ordinateur. Contrairement à la majorité des exchanges, vous n'avez pas besoin de vous KYC et vous récupérez la majorité des frais que vous payez. Plus de 60 000 personnes utilisent déjà DYDX et j'en fais partie. Alors qu'attendez-vous? Scannez le QR code sur votre écran ou utilisez le lien dans la description pour créer votre compte avec un simple wallet et profitez de 5% de réduction sur vos frais. Allez, on repart sur l'interview.
Yeah, I mean, I understand this kind of strategy. Personally, I'm more into like those kind of strategies during a bear market because like I believe that there is maybe like more money to be made, or like compared to that, like the opportunities that you would have like in this kind of environment. So, I mean, it's hard to tell. All the APR is like very volatile, like on those kind of strategies. Like you mentioned, it was possible to have like 100% APR on stablecoins so far with like your strategy. Is it possible to have it like those kind of APRs during a year, in your opinion, or will it end up like being like lower at a point?
Well, so the strategy I just described was deposit USDC, borrow ETH, take that ETH, go put it into Pendle. Yeah, that APR is going to be variable later in the year. A lot of these Pendle PT tokens, you lock in the yield for like 90 days or like multiple months. The more variable part is the deposit side, where that yield is going to sit out. Do I think that the yield is going to stay at 70% plus on some of these pools for stablecoins? No, like that's going to go away. So to answer your question, probably not for an entire year. But
it's still good to take.
but it's still good to take. And the other thing that like I would maybe push back on is in a bear market, I would rather be holding crypto and not taking the lower yields that I could find in stables, because that's the best time to buy. Once you're in a bull market and things are going up, you want to slowly start moving from the volatile assets into high yielding, safer strategies. If you are trying to at all time the cycle, because as rates go up, that's an indication that there's more leverage in the system and that the risk is getting higher for a wipeout. And
so
I think
you're using basically the APRs on like, I don't know, USDC and Ethereum and everything to kind of like monitor the state of the market and understand like if it's maybe a good time to decrease your risk, for example.
Yeah, I think it's one variable that needs to go into your like model of how things are looking, but the amount of leverage in the system does tell you how much risk there is of a large drawdown. And we've seen large, like 30+% drawdowns in previous bull markets, even on the way up. And so depending on how actively you want to manage that, a good indicator for how at risk we are of a drawdown is the amount of leverage in the system. Now, you obviously need the market to correct a certain amount in order to kick off that liquidation cascade, which might not happen. So it's not a guarantee that when rates are high, the market's going to go down, but you should start like asking yourself, if the market did draw down, which is now a reasonable possibility of like a big correction, am I going to be okay with that? And positioning your portfolio accordingly, I think is wise. And one of the best ways to infer how much leverage is in the system is where the interest rates are at, because those are a direct function of whether it's perp funding rates or spot leverage rates, how much demands there is for people to either be going long if rates are higher on USDC or going short if rates are higher on things like Bitcoin.
Before going deeper like into Prime Protocol and high return capital, maybe could you explain to my audience like what is like Citadel and what are the main lessons you learned from there, and also like what are their like crypto appetite, like does like ETFs change anything like at Citadel, or were they super early on crypto? Like
well, I would say first, we are still early, because when I was at Citadel, they had no crypto appetite. And Citadel is one of the like largest, most respected hedge funds in the world. So I was on the hedge fund side of Citadel. It's broken up into two pieces. There's Citadel Securities, which is really a separate company that is also owned by Ken Griffin that has a similar name. And they do market making, and they also do some prop trading in there. I have a bunch of friends who work there, but in terms of like when I was working at Citadel, they do have a pretty strict Chinese firewall between the companies. So we don't have any visibility into what goes on there. That's the entity that invested in Paradigm, or Paradigm invested in. And so maybe they're getting more involved with crypto. What I do know is that anything that they're doing with crypto is being done offshore, because they're allergic to anything in the US because of regulatory concerns, which I think is reasonable given how big they are and what they have at stake. On the hedge fund side, they're very risk averse. So they didn't want to touch crypto because they weren't sure about regulatory. They thought maybe we could do some Bitcoin as a macro play. And now that there's an ETF, I think it would be a lot more palatable for them to touch it. Do I think that anybody has integrated it into their strategies? I can't know for sure since I haven't been there in a couple of years, but maybe. I hope so, because I think broader adoption from big players like that is definitely helpful. And if it increases demand and visibility for it, that's going to be good for the world as a whole. But they're definitely going to be one of the last ones on the train. So if anything, like Citadel is our exit liquidity, or institutions like that, because they are pretty slow to it. In terms of lessons... Yeah. Oh, sorry.
Go ahead.
I was going to say, in terms of lessons that I learned, I would say you learn a lot about risk management. That's something that they take very seriously. And in particular, looking at like if you're managing a portfolio, thinking about, okay, what are the different scenarios in which I lose money, and what are the different scenarios in which I make money, and making sure that your downside in the worst case scenario, you're still going to be in the game, and you're not going to be wiped out so hard that you go to zero, because the worst thing that can happen is you can't play anymore. And then the general approach to trading is thinking about it as like your job as a trader is not to be right every time. Your job as a trader is to basically craft a dice that is going to come up with a high number more often than it comes up with a low number. So basically, like, you want to figure out a strategy that gives you a weighted dice, and you want to be able to repeatedly roll that over and over again. And, because the strategies I was involved in were based more on mean reversion, I think they're actually less applicable to crypto than some of the more directional strategies that are based on momentum. You have traders who are going to trade based on, I think, like, the spread is going to close. Like, a great example of a spread trade that happened in crypto is like the Grayscale Bitcoin Trust versus spot Bitcoin, that big discount that existed. So going short spot Bitcoin, long Grayscale, expecting that spread to close, that'd be like a relative value mean reversion type trade. And while those exist in crypto, they're typically less lucrative. I think what applies more in crypto are a lot of these like momentum trades. Like, if you see a meme coin starting to rip, it's very asymmetric upside, right? Or like, you generally want to be very careful when you're shorting things in crypto, because you could lose infinite money. Whereas if you go long something, you know exactly what you're putting at risk that you could lose. And crypto markets, when you end up in a bull market situation like this, there's not much gravity on prices once people decide to pile in. So I think like a lot of the lessons I learned were definitely helpful, thinking about manage your worst case downside scenarios, and think of it in terms of scenarios like, if Celsius happened again, what's the equivalent of that happening today, and how would my portfolio look if that happened? But I think other things that we focused on aren't as relevant. Like, I wouldn't recommend you necessarily try and create a beta neutral long short strategy of cryptos, because you're going to lose so much money on those shorts. And if you're wrong on a couple of those shorts, it could be a disaster for you.
I was interested in speaking about like the ecosystem and like the role of Prime Protocol into the ecosystem. But before, I was like interested in knowing, like, is it hard to keep up like in this market, because like it is growing so fast? Like, is it hard to keep up and work and being able to innovate and like still innovate whenever like other people also innovating at the same time and maybe doing the same thing, like how was it for you to create Prime Protocol and trying to be different and relevant in this ecosystem?
Yeah, so I think obviously there's a lot to do in a bull market. One of the things that I think that Prime has on its side is the kind of application that it is. It was really the first one to launch. And so we're building a solid track record of not having users lose funds and being stable and reliable. And I think the longer that we can build that track record for, the better. And that's a lot of the reason why people trust protocols like Aave. And you can build Aave with some tweaks on it, but people are always going to be a bit more skeptical. And I think rightly so, because it hasn't been around and battle tested as much. So I think that's one of the things that Prime has going for it that is really hard to take away. I do think innovation obviously is important, and we've been working on a bunch of stuff internally on the message passing front. We've been working on stuff internally on version 2. We've been lining up new chains and assets to go live. And obviously there's the, I believe we said that we're looking at our TGE coming up at some point in the near future. And so all of these things, we want to make sure we get them right and we do it well. And there's a lot of noise in crypto. I also think that multiple people can be successful in crypto, and the market's big enough for that to happen. So I think what matters the most is focusing on your own product, making sure that you're delivering utility to users and that you're doing it safely. And if other people in the same vertical are successful, that's good for us, because that's ultimately, we want everybody's token to be worth more. We want everybody to have more TVL, and we want more users in the ecosystem. And maybe other people have liquidity that isn't available on our protocol. Maybe we have some that's not available on other people's. There could be interesting strategies that come up between different protocols with like rate arbitrage. So I'm pretty excited to see the ecosystem evolve, and I think we're in a pretty good spot in terms of the competitive landscape.
Could you explain, like in very simple words, what are the differences with like Aave, Morpho, or like the other competitors in town, and like in your opinion, also, who are your main competitors? Because I guess you have like competitors that are doing maybe quite the same thing, but with like, I would say, an old school way to do it, and other ones that are trying to innovate and go cross chain, like in your manner, like so.
Yeah, so I guess Aave and Morpho are obviously different because they're single chain. Aave is the same kind of pool-based lending, and the main advantage that they have is track record and liquidity. What they don't have is now they haven't really done anything new for a few years. And so if you think that there's going to be a need for people to interact on multiple blockchains and try and cross-margin their portfolio and run cross-chain strategies, I think Aave isn't quite going to serve their needs, although it's certainly good at what it currently does. Morpho, also single-chain lending. The main advantage of Morpho is by basically matching people rather than having a solely liquidity pool based system, they're able to offer better rates to depositors or better rates to borrowers, depending on how you look at it, because you're basically having the money go from the borrower one-to-one to a depositor when you find a batch. The downside, again, is that's great for very simple like looping strategies or simple single chain borrowing. But if you want to be able to have collateral on multiple chains and have that work together, you are ultimately going to be restricted. And ultimately, the way that manifests itself is you're restricted in the kinds of collateral you can use or the things that you can borrow. I think other cross-chain protocols that we've seen pop up, there's Radiant, which has gotten a lot of interest and a lot of TVL. They've said that they're going to go cross-chain and do cross-margining, but to my understanding, they're still working on it. So their current version is of what they've got live is a Geist fork, which is a fork of Aave, and with some extra tokenomics design. And I think they did a really good job with their tokenomics. And it's offered a lot of value to long-term RDNT token holders, and they did really well at that. And they decided to focus on that before they focused on going cross-chain. And we've sort of done it in a different direction and focused on delivering the product before we deliver the token. We'll see how that ends up going. But I feel pretty confident that right now, at least from a product standpoint, we have something pretty unique and competitive. And we've also seen some other approaches using different message passers like Wormhole. I think the main thing to look for is like, the difference between us and other people who are trying to do cross-chain lending is the variety of tokens and number of chains that are being supported. I think you'll see differences in the collateral types and what you're actually able to borrow on all of these different protocols. So that's mainly where the differentiation is once you've got protocols that can do cross-chain margining.
So to explain it in simple words, and you tell me if I'm wrong. So on Aave, so basically I can like lend some, I don't know, USDC and borrow some Ethereum, but everything is like on Ethereum, or everything is on Arbitrum, or everything like is on a single chain. Compared to Prime Protocol, where you can basically, for example, lend USDC on Ethereum and borrow, I don't know, like Ethereum on Arbitrum, and then lend those like Ethereum on Arbitrum to borrow, I don't know, something on Base or on any other chain, basically, right?
Yep,
and
exactly.
So like, here the point is to make it like easier, but so far like now like the like bridge solutions are getting better and better. So do you think it is like still relevant, or like how do you see like the biggest advantage of Prime Protocol into that? Like, is it more focused for like I would say advanced strategies, like cross-chain advanced strategies, or like is it just like, are you just interested in making everything easier?
I think it's both. It's also economically better because with a lot of bridges, like if you want to use something like a Squid router, you pay fees. Yeah. And so the effective APR that you're paying on that borrow, if you're only going to have it open for even a few weeks, is actually pretty high after you factor in like 50 basis points each way. You're like doing swapping.
That's awful.
So yeah, it actually, from an economic standpoint, is better to take the variable rate and not have to pay the bridge fees back and forth. So that's point number one. I think point number two is there's different kinds of collateral that you're not going to be able to bridge, like, or use as collateral on a different chain. Like, let's say you want to use some like stake token. Like we're going to be launching some restaking tokens soon. And you want to use that as collateral for a borrow that you're taking out on Arbitrum, like not Arbitrum, like Avalanche. It's going to be really, you either have to do all your borrowing on like Arbitrum or ETH and then bridge over. But then if you also want to use some like AVAX as collateral, you're not going to be able to do that all in the same place very easily. You'd have to either borrow 2 different lines of credit. You have to manage multiple positions. You'll also probably end up taking less risk because you have to manage 2 different liquidation thresholds. Whereas if you have it all in one place, it's just a much cleaner, smoother experience. So that's I think one of the main advantages of having it all in one.
Do you think like your competitors will go after that? Go after that kind of solution and try to offer it? Or is it like too early and too dangerous for them to offer it?
I think with the speed at which you move once you're a large incumbent like that, it would basically require an overhaul of their whole code base. And so I think it's very unlikely that they try to compete on that. I think they would either perceive it as too risky or too large of a change to implement. And a lot of their incumbency advantage would, go away if they had to make significant modifications like that.
Avant de poursuivre cette vidéo, je t'invite tout simplement à rejoindre mon Discord dans lequel tu peux retrouver plus de 10 000 traders actifs. Dans ce Discord, on parle de nombreuses choses, notamment on va tout simplement partager nos analyses, nos graphiques, sur quoi on spécule, les différents airdrops qu'on farm, les news en temps réel qui sont partagées par exemple sur Twitter ou sur différents sites. Enfin bref, c'est vraiment un moyen d'être à jour sur ce qui se passe dans l'écosystème. Et en plus de ça, sur ce Discord-là, je vais partager tout simplement pas mal de données et pas mal de choses que je surveille personnellement, donc des données qui sont importantes à mes yeux et tout simplement moi personnellement ce que je surveille au quotidien. Donc ça permet vraiment d'avoir un suivi en temps réel de moi ce que je regarde et comment je me positionne dans l'écosystème. D'ailleurs, tu peux retrouver mes performances de 2022 et 2023 sur tous les trades que j'ai partagés gratuitement et publiquement. Donc ici, tu as absolument tout le détail avec les positions disponibles de manière transparente, mes positions actives, mon folio, ainsi que tous les trades que personnellement je prends de mon côté avec le suivi de comment je déplace mon stop loss, comment j'ajuste mon risque, comment je me positionne, etc. J'espère que ça vous plaira. Tout est gratuit. Je vous invite à rejoindre. Tout sera en description, en commentaire épinglé. Et maintenant, place à la vidéo.
When it comes to TVL, so far like the TVL of Prime Protocol is pretty low, but it is growing. Like, how do you get more TVL? Like, what's the game behind that? Like, how does the big names get more TVL? Because like getting more TVL, I think helps the protocol to be more relevant, to work in a better way. So how do they get that kind of like big TVLs we can see like with like, I don't know, 500 million, 1 billion TVL and everything?
Yeah.
Like, is it like political? Is it all about incentives? Like what's behind the scene?
I think it's probably both. There are obviously like large whales that once you pass a certain threshold, it's going to be much easier to get. And I think in order to get to that point where you hit an inflection point, a lot of it does come down to incentives. And we don't have a native token yet that we've been using to incentivize. So I don't think it's a surprise that it's been slower to bootstrap. Once that changes, I think it'll be a big advantage for us. And the flywheel can start going. So I think that's one point. I think the other point is just working on awareness, which we'll be investing more into. And then the last point is offering new things like new kinds of collateral and things to borrow that the competition doesn't offer. And so that's also what we're working on right now. And I think with those 3, we should be able to accumulate more.
You mentioned that you're basically cross-chain. So basically I can lend like an asset of a chain and borrow another asset from like another chain. Like how does it work exactly? Like are you using like solutions? I think you mentioned Wormhole. Like do you use other solutions in town to offer those kind of services? Like how does it work? Like in the backend?
Yeah. So for message passing, we use Axelar and Layer 0. So when you do a deposit, let's say you do a deposit on Avalanche, or any chain that's like a satellite chain, there's a message sent over either Axelar or Layer 0 that goes to the hub chain, and the hub chain basically records your deposit and it keeps everything in one place. So we know all your deposits and borrows, which easily allows us to price your account's liquidity and your account's health, and then make borrowing and withdrawal decisions based on that. So if you have enough account health, then we'll allow you to take out more borrows or withdraw, and everything would also be passed over a message passer like Axelar in order to make that happen. So let's say I'm on Avalanche and I want to request a withdrawal, then there'd be a message that goes from Avalanche to the hub chain that gets processed. And then there's a message that comes back, and then the tokens are released. And the reason why we do it this way is because if we tried to maintain state on a ton of different blockchains all simultaneously, that would be a big security problem, because then an attacker could come in and try and spoof the network, try and get things out of balance, and then withdraw or borrow inappropriately.
So those like Axelar and Layer 0 represent like a single point of failure for you. Like how do you address maybe the issues that you could have like Axelar and Layer 0? Like
I think the largest issue would be like downtime, and that's why we've implemented some amount of redundancy. We also have message protection where, let's say you initiate a message on one message passer, and for whatever reason, like their relayers go down and you're not able to deliver that message. We cache that message on the source chain every time as a unique hash, and we allow you to resend it. And so that could, like, let's say Axelar's relayer goes down and we need to resend it over Layer 0. We could do that. And then going over Layer 0, when it receives the message at the other end, we also cache the hash after that message has been processed. So no message can be processed twice, even if you retried it. And so this basically prevents us from having like one message passer go down. In terms of the security of the message passers, obviously that's really important, because if you're able to fake a message, that would be bad for any cross-chain protocol. And so that's why we chose, we're only working with, the most secure protocols in the ecosystem that I think are really tier one in terms of their approach to decentralization and security. And so I think that's how we've approached that side of things. We didn't want to build our own bridge solution because we figured these guys have literally hundreds of millions of dollars of investment and poured a lot into the R&D of building something really secure.
Do you think that Layer 0 and Axelar are, I would say, the solutions and the projects that are the closest to solve this liquidity fragmentation issue? Or like, is there any other big names in town that sounds like still relevant? We mentioned Wormhole. Maybe there are like other solutions, I don't know, Polygon is working on, or Synapse or whatever. So are there like other good solutions available? And even when it comes to Layer 0 and Axelar, like could they do like something way better? Like how could they improve on their end?
Sure. I think there's other solutions that are also great. Like you said, Wormhole is a fantastic solution, and I think very highly of the team. I think that it works very nicely. There's also like Chainlink's solution, and there's other optimistic solutions. Like you mentioned one, Synapse, and there are some other ones like Hyperlane that are taking more of a permissionless approach. I think there probably will be more in the future as well, using more like ZK approaches. And I can't wait for those to come out. I think each one has its own pros and cons. Like with Layer 0, it's very configurable because they have an Oracle or Relayer that you could run, or you could run theirs, and they both have to agree in order for a message to go through. The downside of that is running your own infrastructure can be somewhat risky, and it's a bit more centralized than a solution like Axelar, which has tons of different nodes that are running and like economic security behind it. The downside of that is there's a bit more latency because those nodes need to come to consensus. And for something like a Layer 0 or Wormhole, where you have fewer parties that are needing to come to consensus, in Wormhole it's the case like 13 guardians, it's a bit faster. So those are the general trade-offs. And then I think there's also, once you actually get into what you can build with each one of them, that also ends up being a bit different. Like Axelar has their own chain, so you could deploy contracts on that chain that then get deployed to others. And I think there will be some cool applications built on that. Whereas I think Layer 0 is going more like, we want to service institutions that need maybe custom solutions, but want battle tested infrastructure in order to deploy that. So I think they each have their own lane, and all of them are valuable.
Thank you very much for that, because I think like from like a retail perspective, it is very hard to understand like what are the biggest differences and like how Axelar and Layer Zero are integrated like in like real solutions that are used by everyone. So I think it is very interesting. I'm about to interview the founder of Axelar, so I was wondering if you have any questions for him, like for his next interview.
All of the questions that I have, I just asked him directly. I
something
think
that could be interesting for my audience, maybe.
I think you guys should definitely talk with Axelar about contracts that can be deployed on their chain, or like their deployment suite. I think they're doing a lot of really interesting stuff around enabling cross-chain governance or natively cross-chain applications where they provide the infrastructure. And this, I think it's maybe hard to understand from a retail perspective, but it makes a big difference from a developer's perspective if you have those tools. And they would have been, if they had been available a couple of years ago when I started Prime, it would have been a godsend and it's made our lives a lot easier because we had to build a ton of custom deployment tooling, which actually took like months because all of the existing solutions like Hardhat were built for single chain applications. And so we like invested a lot of time and resources into a secure deployment suite, which really matters because when you deploy the contracts, you have to make sure they're all hooked up correctly in order for everything to work smoothly. And then if you want to deploy, say, like another chain or another asset, making sure that you're making all the right calls to each of the contracts on different chains so that they all recognize each other. That's all really important. And I think Axelar has a really slick solution that they're working on for this.
So lately you joined the VC game, which is like, I would say like a different game from like the builder game in a way. I mean, you're still working on Prime Protocol, but now you're like helping on Harrington Capital. So what motivated your move to like work as a VC, and how does it look like?
Well, I think it was just pretty natural. I had built a relationship with the Arrington folks for a while and was already giving them some help on like the technical diligence front, taking a look at some things. And I think at the time that I joined, there was a real opportunity for somebody with my kind of background to help make a difference for the other portfolio companies, and thought it would also be beneficial for building my own network, and that would also help Prime as well. So I think being a VC it's been very interesting to see the other side of the table. The difference in cadence of like my work at Prime, it's like the same threads that you're pulling at for a while. And on the VC side, you're seeing a ton of different stuff. So there's a lot of variety. And so I really like having that balance of getting both. And I also think it keeps me very sharp, having to basically stay abreast of all of the new things that are going on in the ecosystem. And having to constantly be learning about what else is out there. And that's one thing I really enjoy about the VC side. And I'm sure like, as a retail trader in DGen, I was already doing that, but I think I let that go to the wayside a little bit when I was, just in the depths of the bear market, hacking away. And I think it's good to have a forcing function to keep you involved and keep you learning.
Have you been surprised by anything working as a VC, or like were you shocked of some stuff like you've seen being at like the other side of the table?
I haven't been shocked.
I don't know, maybe strange decks.
Yeah, I think, well, there's definitely there's a lot of stuff that's being built, and obviously not all of it has legs, and just the sheer volume of activity in the crypto space I've been surprised by, because people are like, retail is focused on a few projects at a time, right? There are a few like high profile launches that are happening and everybody tends to know about those. But what I don't think people see is just the sheer number of new ideas that people have and things that are in the pipe. And I think that's what I actually have been finding the most interesting, is seeing all of the new ways in which crypto is going to evolve. And by seeing them at early stage, you can kind of see, wow, like there's something that's probably going to come out in 2 years, but it's going to be a real game changer for the AI space or the DePIN space. And I think that's really exciting to basically get like an early look into a lot of like the emerging technologies like as they're being developed. And the amount of activity is pretty surprising. Even during the bear market, there's still like a lot of stuff that was going on. Most people were having trouble getting funding over the bear market. There were still people like wanting to build, which I think was really encouraging and just made me more bullish on the ecosystem as a whole.
Yeah, I 100% agree, because myself, like I have a small family office, and like it's very cool to understand like what will happen probably in the next 6 to 12 months in terms of innovation, because VCs like see it first. You notice like what are the biggest coming innovations before like anyone, I would say, in the ecosystem. I would say before the retail at least. So which is the position I was in for the past cycles.
Cette vidéo vous est présentée en partenariat avec DYDX. DYDX est la solution décentralisée qui vous permet de trader les principales crypto-monnaies de manière liquide sur mobile et ordinateur. Contrairement à la majorité des exchanges, vous n'avez pas besoin de vous KYC et vous récupérez la majorité des frais que vous payez. Plus de 60 000 personnes utilisent déjà DYDX et j'en fais partie, alors qu'attendez-vous? Scannez le QR code sur votre écran ou utilisez le lien dans la description pour créer votre compte avec un simple wallet et profitez de 5% de réduction sur vos frais. Allez, on repart sur l'interview.
I wanted to understand like what are your views on the current market valuations? Is it still a good time to invest? Like, and how does Arrington Capital decide on the timing of their investments?
Yeah, it's a great question. I think there's always going to be deals that are good deals at any stage of the market. I think valuations have gone up for a lot of projects that have tokens that are like close on the horizon is generally what I've seen. And
so you mean like the tokens are about to launch?
Yeah, like if the token's about to launch, the market is valuing tokens very high right now, and investors are willing to pay a premium for that because they think they're going to get early liquidity. I think that's not a great way to invest. Personally, I think it's better to invest in like every investment that we're making right now, at least from the Arrington side, we're looking at as like a multiple cycle investment. Partially because you can't expect
low amount of projects like are able to live through cycles. That is pretty hard. So it's like betting and investing on something that is very, very hard in a way, no?
Yeah, no, it's really hard, and I actually think that most of the money that people make this cycle are going to be from investments that they had made previously. Now, if you're investing in liquid tokens, different story. You can totally make a ton of money this cycle by investing in liquid tokens because you're able to sell. But if you're investing in something that has a multi-year lockup, there's no guarantee that you're getting those tokens this cycle. And it's also, if you just dump everything that you have, it's also bad for the project. We are a liquid hedge fund. Sometimes we'll like trim something 1% or so, but generally we have a few long-term altcoin holdings that we have from venture investments. We didn't sell last cycle, probably won't sell much this cycle, really long-term believers in the project. And that's, I think, the best portfolio to have in crypto is something that you're willing to hold through multiple ups and downs. I think once you start investing in things based on this is going to pump this cycle, I think I can get my tokens and exit soon. That's not the kind of investor you necessarily want to be partnering with, and B, then you're just gambling. And I think we're in the investing business. We want to try and help crypto get to a place where there's more utility, there's more real stuff going on. And so as investors, I think you have a responsibility to try and pick projects that are really value additive to the ecosystem and not more rent seeking type grifts. And so that's generally something that I would say just be careful of, things that are explicit hype machines in the short term. Those often have very high downside as well. And in terms of our criteria for investing, the most important thing is the founders. If you don't have good founders, the project is not going to be successful. And no matter how good the idea is. And so looking for people who are compelling, passionate, have a reason to be building what they're building and are competent, I think is really important. Next most important thing is the idea. Are they attacking a market that has a large opportunity, big TAM? And sometimes this can be like a market opportunity that we think is going to grow massively in the future. And then the last bit of it is, how is the market going to receive this? And is this going to survive over like multiple cycles? Because if you invest in something that's like the hot thing right now, but nobody wants to fund it in a year, it's not just about like whether retail likes it. It's about whether other investors are like going to appreciate what they're building in the future, because you need to get like, it takes a village to get something over the finish line before like the token is even live. And so making sure that the project is going to have proper support, I think, is also important. And we can certainly help with that.
2 more questions, because I don't think you have like a lot of time in front of you. So basically, VCs tends to, I would say, invest most of the money at the peak top, because when we looked at like the amount of money invested like during 2021, 2020, like the biggest amount invested was at basically the peak top of the market. Like, how do you explain it? And also on the other side, like, do you see the role and practices of VCs changing because of protocols practices changing also on the end? We've seen like Hyperliquid not raising a single dollar. I think it's pretty much the same with Jupiter, who are both like planning or giving a lot to the community. So
I think there's definitely some projects that want to be like community run, community led, and I think that's fantastic. And if you're able to pull it off without having VCs involved, like, power to you. I think there's always going to be some projects that need more funding, who are tackling like ambitious projects who need VC partnership and help, and some that can get it done without. I think I'm trying to remember your first question. Investing at the Pico top.
Yeah,
I think that's just human nature. People are always going to have FOMO and invest in the top. And I think you just have to fight your instincts along the way and say, like, if I'm investing without, like, just because other people are interested, that's generally a red flag. And we try to never do that.
But why don't we see like more money invested in, like, now? Is it because like the money is expensive because of like the rates and everything?
Yeah, it's because a lot of VC funds haven't raised their next funds yet, and they struggled to raise money in the bear. In terms of number of deals, we're actually at an all-time high. But dollar amount invested, we're not at an all-time high. And I think that you'll see large institutions like LPs start funding VCs now, and then VCs start deploying that. And once that happens, like later this year, that's going to be at bad prices.
Okay. Last question. Like, so because of the community approach and everything, like, does some projects does some VC FOMO into like those kind of projects that are community led? So for example, if VCs are not able to invest in Jupiter or Hyperliquid, will they fund the airdrops, or is it like something that you don't see among the VCs?
I think like there are some VCs who are airdrop farming for sure. I think if you can participate the same as any community member can, and in particular people who have liquid funds. And I think there are a lot of liquid funds that are buying these tokens on the open market. And I don't think there's anything wrong with that. Like, everybody has a right to participate in the market. And I think it's good for the community to have power players involved who are going to be advocating for the projects.
Thank you very much for your time, Colton. Maybe any last words for this interview for the people who watched like the entire podcast and interview?
Yeah, I would say check out Prime Protocol, check out the fantastic deposit rates that we have on a bunch of our markets, and check out our points program as well. Won't be running for too much longer, so make sure to get in while you still can.